Right, learners, if you managed questions 1 and 2, which was on the general transactions of for the accounting equation, let's take a look at question 3 now, which focus specifically on that of a partnership. Now, the only difference that you're going to come across here is that when we look at the owner's equity, we're not only going to have capital accounts for the different partners, but we're also going to have current accounts and drawings account for the different partners. Now, drawings and capital has been dealt with and there'll be no change. The difference is the current account. And the current account is also part of owner's equity. Now, what's going to come about is largely the division of the profit. So let's take a look now. So I'm on question 3 now. And again, we asked to analyze on the columns. And I'm focusing specifically on the accounting equation. I'm not worrying too much about the figures at this stage, please. You can get help for your figures in other places. Right, number 1 says you record the salary earned by the partner. Now, a salary is a division of the profit. It comes about at the end of the year. So once the profit has been made, they now then divide out that profit. And so partner B's got to get a salary. If you look up here, it said to you partner A earns a salary of 30,000 per month. And partner B earns 1.5 times as much. Now we are dividing the annual salary here. So 1.5 times 45,000 and it'll be times 12. Now when you come to put it into here now, and this is where partnerships become different, you're going to have to debit an account called a salary to partner. Or you can call it salary partner B. That is the expense. It's an expense. It's coming out of the profit. So it's really a division of profits, but it's an expense that's going to reduce the profit. And that money is owed to the partner. So it'll be the current account of B with the amount of 540,000 here now. Now, the salary is an expense. All right? So therefore, like we did before, it's going to decrease the owner's equity. It's going to decrease the profit. But that profit is moving into the current account. And you're now recording that you owe B this money. So his current account has been credited. It will be increasing. So one owner's equity account is going to decrease. One is going to increase. What you're really doing is you're dividing. You're allocating some of the profit away, calling it a salary, and you're putting it to the current account. And then obviously the others will be unchanged. And the amount here will be 540,000. But I say I'm not going through these calculations now with you. Then if we look at the next one, it says to you that partner A withdrew 75% of his salary. This was his only drawings. Now, this withdrawal of this profit could have taken place at the end of the year. It could have been taking monthly throughout the year or at irregular intervals during the year. It makes no difference. Whenever a partner takes any money out of the business, it goes to his drawings. So he is drawing out, so the bank is going to be involved here. And just like before, we'll have a drawings account. But because it's a partnership, you must put in the name. It's drawings A in this case. And because he's taking money, it's the bank account. Now his salary was 30,000 a month, and he's taking 75% of it, so 270,000. Right, now bank is the easier one here. Bank we know from the previous exercise we did, bank is an asset. It's taking money out, so your asset is decreasing. But drawings is decreasing the owner's equity. He's taking money out of the business, so he's got a smaller investment in the business. Nothing changed from whether it's a sole trader or a partnership there, other than the fact that you call it by put his name on it. Right, now if we look at number 3 and number 4, number 3 asks you to record the interest earned by partner A, and number 4 the bonus. Now these are similar entries to number 1. It's just the nature of the division is changing. So you're going to have interest on capital as one, and you're going to have a bonus to partners as the other one. So these are the three divisions of profit. It can be paid out as a salary, an interest, or a bonus. And so because these are all reductions, divisions, they're expenses, they all get debited. And you will credit the respective current accounts. All right, and I'm going to abbreviate now. The interest on capital went to A, and the bonus went to B. And exactly the same as what we did in the first one. The interest and the bonus are expenses, so they will reduce your owner's equity. The current account, you are allocating money to them. They've got more money in their current account, so it's a plus minus. So that is exactly the same as what it was in number 1. Now, once the allocation has been done, you've actually, according to the partnership agreement, allocated the salary, the interest, and the bonus, which is per the agreement. Not what they've taken out, it's what the agreement is. Once that has been allocated, we then have to close off the accounts, or as it says here, show the transfer entry of the interest on capital. So you've got an interest on capital account which you have now debited, although there'll be 2 partners obviously involved as far as the amount is concerned. You're now going to close that. So to close a debit, we're going to have to credit the interest on capital account. And these divisions of profit get transferred out of the appropriation account. Out of the appropriation account. Now, the allocation of that there. Appropriation is a final division of profit. It's the account in which we divide out the profit. It's concerned with the net profit. And so it will also go under owner's equity. Interest on capital, we've already seen, also went under the owner's equity. Now, when we allocated the interest, we said interest on capital was a minus. It would be reducing the amount of the total profit. We're now cancelling it, so we're plus and minusing. Now, I know that could be quite difficult to understand, but the important thing to realize is that both of these affect the owner's equity, and therefore one has to be a plus and one has to be a minus. And you will do exactly the same now with all the rest of the entries over here. You will actually close off the bonus, the salaries, all to the appropriation account, and they'll all be under the owner's equity because they're affecting only owner's equity accounts. So really, what's going to come in when you're doing a partnership accounting equation is to remember that the current accounts, the appropriation account, the capital account, the drawings account are all affecting the owner's equity. And likewise, the salary, the interest, and the bonus are all expenses, which are reducing the profit. You're really taking, if you think about it, you've got a pool of money, you're taking it out of that pool and you're allocating it to individual people. So it's not that you've lost the profit, it's coming out of the general pool and going into individual people. Right, as long as you can get that concept, then you should handle accounting equation entries to do with the partnership. Please remember, though, to always write the name of the partners. Don't just write current account or just drawings account. Right, so please carry on now and practice number 3 and number 4 of these exercises.